Hey everyone, it's Bob with another FINOP Controller webcast. Today we're going to discuss the requirements of U.S. broker-dealers regarding the possession and control of their customers' securities. We're going to cover the following 5 questions. What type of property is covered under the possession and control rule? And note that the rule covers both customers and broker-dealers that hold their property with the firm. What exactly is possession and control? And does it apply to all of the property held in customer/PAB accounts? How is possession and control determined, and what does it mean for security to be in SEG? And finally, what does the firm have to do if it does not have sufficient shares in SEG for a particular security? Before we get started, let's go through some disclaimers and notes. First one is that this presentation is for educational purposes only. It's not legal advice. If you need in-depth information regarding possession and control, I'm going to direct you to the finra.org website where you can get the financial and operational rules for broker-dealers. Now, note that new products are developed all the time. It's really up to the firm to determine how they should be handled under the rule. And just because the rule does not mention a particular product does not mean that you can ignore it. So if that's the case, then you should consider how similar products are treated within the rule. And then the last one is, one way you can use this presentation is to review it versus your firm's operations and compare the various items. So let's get started. All right, so here's a list of the property that's required or that is covered under SEA Rule 15C3-3. And notice you can really break it out into 2 different types. One of them is securities. The other one is cash. Cash we've covered before in prior videos. So let's go ahead and talk about the securities. Securities can be debt or equities. They can be derivative securities such as options. And also, recently, they've added securities futures products, and those are futures contracts on single securities or a very narrow index. Now, notice we're saying customer or PAB, and so what does PAB stand for? And that is the proprietary securities account of a broker-dealer. And what that means is that broker-dealers, as well as regular retail customers, can hold accounts at other broker-dealers, and their particular property will be covered under this rule also. So what is possession and control? Well, for physical possession, the broker-dealer is holding an actual paper certificate. This was very common back in the 1970s. Since then, the industry has worked on a process called dematerialization. In that particular instance, securities are issued book entry only. However, there are still certificates out there that indicate ownership, and if a broker-dealer has them, back in the 70s, they would have held them in a large vault. Nowadays, it is probably just simply a fireproof file cabinet. Now, with control, the broker-dealer uses a custodian to hold the securities for which it's responsible. An example for that would be a bank or the depository trust company in the United States. Now, with a depository trust company, most of those securities are held in book entry form. And the way that works is that there is a jumbo stock certificate that is deposited by the issuer with DTC. And then from there, DTC makes entries for all the broker-dealers that have customers that own the securities. And then going a little bit further, the broker-dealer themselves have records for all the securities held by their own customers. This occurs because of dematerialization or book entry only securities. And again, as I said before, it just makes it easier for the customer to buy or sell securities or to lend their shares when no physical certificates have to be transferred. Now, fully paid for securities is exactly what it says. The customer is paid for all of the securities, and they're usually carried in the customer's cash accounts, or they can be held in a margin account. Excess margin securities is a little bit more complicated, and they occur when a customer buys securities on credit or using a margin account. The securities are held in the account, and they're used as collateral to back the loan. The rules don't allow for all of the securities to be used to back the loan. In fact, they top the amount, the market value of the collateral at 140% of the actual loan. So if you're holding securities with a market value greater than 140% of the loan, Those that are greater than 140% are excess, and those excess margin securities must be held or kept in possession and control of the firm. To illustrate, let's go through a simple example. Here we have an account that has securities worth $1 million, and it also has a $100,000 margin loan. So our question is, what is the market value of the securities that are considered excess margin and must be held in segregation? The solution is as follows. You take the $100,000 margin loan and you multiply it by 140%, you get $140,000. You subtract that $140,000 from the $1 million of market value of securities, and that'll give you $860,000. So the answer is that $860,000 of the securities must be held in segregation for this account. All right, let's turn our attention to the firm's stock record, because it's from there we'll be able to determine how many shares that are required to be in seg for a specific security. So when you're going down through the stock record, you're going to see that for each customer, if they have fully paid for shares or excess margin securities, then there's going to be an indicator, and that's usually an S, that shows that these shares should be segged. Now, if a customer has unpaid for shares, then the stock record will have a separate line item for the customer showing those shares. The stock record is the basis for the deficit report. On a daily basis, the firm will review the deficit report and determine how it will clear or remediate securities that have a deficit, meaning insufficient shares held in possession and control. Note that the rule has specific time frames that must be followed regarding clearing the deficit. The next slide shows what actions must be taken if the deficit is not cleared in time. How the deficit occurred will in part determine what action is needed. So what happens after a deficit is discovered? The firm will determine the root cause of the deficit, and based on that analysis, the firm will consult the rules for the amount of time it has to close out the transactions causing the deficit. If it's not possible to close out the transaction, then the firm will usually have one of two options: either buy replacement securities for the customer or borrow shares to cover the deficit. Note that these options are not interchangeable. The firm must consult the rules to determine what action it must take. That's it for this video. If you have any questions, please send me an email at bob@rmmilburnconsulting.com. Thank you for watching.